Welcome back everyone to the fourth session of Bernstein India Quant Series Season 2, where we try to get fund managers' perspective on various aspects of quant investing in Indian markets. We still have one more session left on Monday, but we would be coming back with similar sessions early next year, so stay tuned for that. For today's session, we are pleased to have the quant team from DSP Investment Managers joining us. Aparna, Karnik, the head of Quantitative Investments and Analytics, and Pratik, Nigudkar, the risk and quantitative analyst. Very quickly on their backgrounds, Aparna is the senior vice president and head of quantitative investments and analytics at DSP Investment Managers. She has nearly 20 years of experience in investments and risk management. She holds a master's in management from Jamnalai Bajaj Institute of Management Studies. Pratik joined DSP in 2017. He manages the DSP Quant Fund and DSP Value Fund in his current capacity. Pratik has over 10 years of experience in quant finance, thematic research, and risk management. Prior to joining DSP, he was briefly with State Street Global Advisors and for over 5 years with Credit Suisse India Private Banking Research. He holds a master's in quantitative finance from the Washington University in St. Louis. Both Aparna and Pratik would be spending the first 30-35 minutes taking us through the broader aspects of the relationship between macro and factor returns when it comes to Indian markets. We would then have a fireside chat with them for the next 15 to 20 minutes, and then we would open it up for wider Q&A. For your questions, please put in your questions in the Pigeonhole link that was shared with you with the session invite. With that, I would like to hand it over to Aparna and Pratik.
Thanks, Rupal, for your kind introduction, and we hope it will be an interesting session today, and we look forward to receiving lots of questions from the audience. Look forward to their participation in the chat. We will just we had just prepared a few slides just to help us illustrate some of the themes that we thought would be useful to talk about. So why we chose this macro and factor returns, we believe it's extremely topical in the current environment. I mean, in the last 2 years we've seen really huge unprecedented swings, you can say, in macro factors, and that has definitely had we've seen it has had a major influence on factor behavior also in the last couple of years. I mean, this word unprecedented has become like a very commonly used term. So this is something which we also have been studying, and this is something which plays on our minds. We spend a lot of time researching this, so we thought this is something we were hoping would be a topical aspect to discuss in today's call. So I mean, when we talk about the swings, what we're essentially talking about is that huge growth shock that happened when COVID struck, with complete collapse in growth, and then that was followed by again unprecedented sort of monetary and fiscal stimulus unseen in last 4-5 decades of our investing observations. We saw this kind of stimulus which flew through the global economy, create massive demand surges, and ultimately it resulted in post the reopening massive inflation. And now we've come an entire circle where now we're seeing monetary tightening again at unprecedented rates, where we've come back a full circle where again the demand is trying to be curtailed by fiscal and monetary central banks, etc. So in this, and all this has happened literally in a span of not more than 2 years. So this becomes an important aspect for us to consider. Now in our quant funds that we are managing, the factor investing concepts form a very critical or a core part of the fund, where most of the stock selection happens using very academically time tested factors such as low volatility, quality, growth, value. These are factors where essentially there is evidence of long term excess returns, excess risk adjusted returns over decades, and there's evidence across markets, including in India. So these form the building blocks of our fund. The theory, if you just step back a little bit to the theory of factor investing, why these kind of excess returns are there, or are expected by taking exposure to certain factors. Again, it drives down to basically two things. One is either it is a compensation for bearing additional risk, such as your value exposure to value stocks, or small cap stocks, where there is a higher risk of distress or a higher vulnerability to the economic cycle, and investors who are taking exposure to that factor are compensated for bearing that risk. The other reason, of course, is behavioral. There are these systematic mistakes or errors which investors make, such as chasing behavior or risk aversion or overreacting. And again, momentum factor, for example, harvests this chasing kind of behavior, and quality factor harvests this kind of a risk aversion. And so these are the reasons why factor premia have existed and are expected to exist in the future. However, while this is true, again, there's a lot of literature on this. There is no free lunch when it comes to factor investing. Essentially, these premia, for any investor, it is important to understand these premia are, possible to benefit from over very long periods of time, over a full cycle, and over short periods of time you can have. And when we say short, it can go up to 2 to 3, and even we've seen in the past more than 3 years of consistent underperformance of factors, and each and every factor. So it's an inherent characteristic of factors that they're cyclical. And in fact, this inherent cyclicality is one of the reasons why the premia exist. Because investors, anecdotal evidence shows that investors are short-sighted in their behavior, and they don't have the patience to sit through that long term to harvest the alpha. And so the very cyclicality which the factors sort of behave, that is the reason why the premium exists. And it's very important, we thought, for investors also, because this aspect needs to be clearly understood when anybody is trying to invest in any factor based funds. And so we will move on to the next slide and try to look a little deeper at how macros sort of how they impact or influence factor performance. So this is a very simple, to be honest, this is a very simplified sort of a 4-grid framework or that we use. There are many more macros, but by and large, what we wanted to do was just explain. So here, essentially, we've divided the economic conditions into those characterized by inflation as well as growth, real GDP growth. So, for example, recessionary environment is one where you have a slowing macro where growth is slowing down, and inflation is also falling as demand is falling. So in these kind of scenarios, obviously defensive quality stocks tend to do better, because these are tough macro situations, difficult for companies to survive. So those companies with a good balance sheet, and a good pricing power to retain their earnings, they tend to do better because they're able to actually demonstrate better earnings than the rest of the market. So it's kind of commonsensical. Stagflation also similar, poor growth, inflation remains stubbornly high, something similar to what, we may be, the kind of environment we are in or maybe getting into, where again, more defensive stuff tends to do better than, factors which are more pro-cyclical or more positively correlated with the economy for obvious reasons. Overheating, we have seen these kind of environments benefit value stocks. Again, it's kind of commonsensical because this is an environment where you have capacity shortages, huge demand, and value tends to be characterized by companies in the let's say commodities or energy space, where their earnings are highly cyclical, linked to say commodity prices, etc., which tend to be very strong, when demand is very robust and the economy is hot in a way. So these kind of stocks do better because they have disproportionately higher profits. Similar, like what we've seen, for example, in the last year or so, metals companies, they had massive sort of exceptional profits over the last cycle than what they have seen in the prior to COVID period. And a Goldilocks, environment, good growth, inflation under control. Investors pay for growth stocks. Growth stocks are the glamour stocks. These, demand is robust. So obviously, stocks which have better growth characteristics tend to show better results, better earnings, and these are favored by investors. So it's kind of commonsensical, but it's important to understand that different sort of macro environments favor different types of characteristics. And just to move on to the next slide. So this is just more of the theory, but we have actually we've actually characterized last 20 years in the Indian market, by these kind of 4 quadrants: recession, overheating, etc. And we have studied the behavior of Indian factor portfolios. Like factor portfolios, we have constructed using Indian stocks, and we've seen this bears true. Like for example, here you'll see in this table that in the overheating environment, it's a value and growth stocks which outperform, and the quality stocks, while they give positive returns, they are underperforming. And in a, say, stagflationary environment, the quality stocks tend to fall much less as compared to the, say, value and growth stocks as well as the index. So we have seen evidence of this type of behavior demonstrate over periods of time. I mean, each and every, as I said, 4 factor is a very simplified grid. There are always nuances, and there are always different other characteristics which are at play. But by and large, we've seen that this kind of a phenomenon tends to repeat by and large over periods of time. So again, like we spoke about, if we look at factor behavior, just next in the next slide. Yeah. So here again, this is a very simple table where there are different factors. You have your broad market on the top, and then you have alpha, which is momentum, equal weight, which is size, quality, value, min vol, etc., and multi-factor. Here you'll see every year there is a different winner and a different loser. So essentially, and there are, it is possible that the winner of one year is likely to be the worst loser of the next year. So this is a very common thing which is observed here in India as well as outside. Again, just reiterating the same thing that we were speaking about. I mean, it's based on a lot of research and numbers that we've observed over time. So again, I mean, knowing this, now what do we do as quants is something which Pratik will talk about in more detail in the next few slides.
Yeah. So, I mean, picking up from where Aparna left, so this is a table of factor returns for every calendar year going back to 2006. Now, if you look at the table, 2 things stand out very clearly. One is that there's no a particular factor that does well across the entire business cycle. There's very little persistence. It's kind of a merry-go-round. And secondly, the dispersion of returns between the winning factor for that year and the bottom-most performing factor for that year is very huge, right? So those are the 2 things that sort of come to mind. Now, the immediate takeaway from this is that if you were to rely on a single factor, to construct your portfolio for the long run, you will need to have a lot of patience, right? Because that chosen factor that you have in your portfolio, it may have small periods of underperformance. So patience is a virtue that one needs to have as a long-term investor if he has to succeed, or he or she has to succeed in terms of long-term investing. So hence at DSP, what we do is we have a multi-factor approach, right? Where we try and harness factor premia from a various of these factor sources. So we just don't rely on one particular factor to give us that outperformance that we're looking for. Now, having said that, the huge dispersion that we see for any particular year, between the best performing and worst performing factor, that sort of is very enticing, in a sense that if you were to get the factor timing bit right, then there are huge gains to be made. There is a huge alpha there on the table. While we realize that factor timing itself is very hard, I mean, there's no harm trying, right? So there have been academics who've sort of taken a stab at it, and they've tried to sort of look at how we can approach this problem of factor timing. right? So the most typical approach that most people do is through macro-based research. That's one of the most common research that is out there in the factor timing. The attempt here is to look at a series of these business cycle indicators, things like inflation, your PMIs, your consumption data, bond yields, those sort of things, and to nowcast these sort of variables and turn it into a signal. That signal can then sort of be used to assess whether which kind of macro regime you're in, and then that can tie into you're sort of tilting your portfolio towards a factor that has historically done better in that particular regime, or turning it away from something that hasn't. So that is certainly one approach. Again, there are ups and downs. There are pros and cons to this kind of approach. One is that it's sort of very intuitive. So that's the good thing about it. The bad thing about this kind of approach is that over the last few years, what we see is that central banks have come into the market and sort of tried to correct for these kind of excesses in a major way. So they've tried to essentially shorten business. What that has led is your numbers or your macro data could be saying one thing, and markets which are forward-looking may be doing something else. Anyways, these numbers that we get from these kind of business indicators, they're lagged, right? And markets are forward-looking. To give you an example, March 2020, the first day of the lockdown was actually the market bottom. So on the day when your macro numbers would have been looking the worst, that was actually the market bottom, and the markets rallied from there. So we have to be, cognizant of the shortcomings of these kind of approaches as well. Next up is momentum. Of course, we know that momentum as a factor works for stocks. It also works for factors, right? So the idea here is to exploit the extension in trends. You've seen a factor do well on a risk-adjusted basis or an absolute basis. The idea is to keep sort of loading up on that factor and hope that it continues to do well. The problem again here is that it makes you prone to these kind of momentum reversals. So once that factor goes out of favor, you could see a potential deterioration in terms of performance, and you will also have to live through a lot of portfolio turnover, right? So momentum brings in a lot of turnover. So that is one thing that need to be careful about. Valuation-based approaches are also fairly prevalent. They don't really work in the short term, but in the long term, and especially at the extremes, if you see, they have tended to do well. So when a factor, if you were to look at the valuation of the constituents of that factor, if that on a historical basis has moved far away from its mean ranges, then there's a likelihood that over the longer term, it may not give you the kind of premia that you would expect from the factor. So that is one approach as well. Short term, it doesn't really work. That is something that we've come to realize. Then there are other approaches, of course, market sentiment-based approaches, risk on and risk off environments. Risk on environments where markets are very benign. You would favor having cyclicals in your portfolio. Those kind of factors. If it's a risk off regime and markets are turbulent, then you probably favor more defenses in your portfolio. Again, this is sort of assessed by looking at realized volatility, for instance, things like the volatility index, the VIX, and try and assess whether the market is in a risk off or a risk on phase, and thereby calibrating the weights to your portfolio. Again, there are several approaches. The one that we take is to sort of integrate a lot of this, not so much macro, but others as well, so to sort of assess which regime may be prevalent, and based on that, what is the factor that may be considered at this point in time. Closely tied to this concept of factor cyclicality is also or factor timing is also this concept of factor crowdedness, right? So what happens is that when a lot of money is, let's say, chasing a particular factor, when that becomes very extreme, it does not really bode well for the future returns or the future premia that is expected out of that factor. What happens is that there is a lot of tail coating, and people sort of try and latch on to something that has worked well in recent times, so much so that going forward the return expectations from that may not be as good. And something that we've seen is that a small change or small shift in positioning can lead to very large or disproportionately large drawdowns in that particular factor, leading to excess volatility that you would want to avoid, leading to portfolio underperformance. So one thing that comes to mind is 2007, the famous Quant quake, or things as recently as November of 2020, when Pfizer announced that they've suddenly discovered this COVID vaccine, and everything that was running well up until that time, all of your unprofitable tech, your FANGs and everything, ARKK kind of stocks, they were down 10-20% for the day, and everything else that wasn't doing well at that point in time suddenly started to do very well. So you run the risk of these kind of extreme events happening once a particular factor becomes crowded. So again, it's very important to have a robust framework, a dashboard kind of approach where you would look at various things and assess whether a particular factor is crowded or not. So to begin with, it's important to even quantify what do we mean by crowdedness. So there are several measures through which we can do that. Things such as relative valuation, for instance, something that we talked about in the last slide. When there's an overarching theme playing out in the markets, the large sums of capital are chasing very handful of securities. When that happens, their relative valuation versus the market, reaches an extreme, and then you run the risk of that coming off and those securities eventually not doing as well as you would expect. Price momentum, that's very important. So what we do is we look at the factor portfolio, the momentum factor portfolio, and look at the overlap of that factor to things like low vol or quality or growth or value. If there's a high degree of overlap by historical standards, again, that can be a red flag for us in terms of the fact that that factor is very crowded. So if you go to the US, for instance, over different look back periods, if you were to construct a momentum basket, that entire momentum basket actually represents the value factor at this point in time. So that correlation is 0.8, 0.9, upwards of that. So that is again, the region where one needs to be very cautious to overweight that factor in a portfolio. So that is one. Other things that people can try out are things like return dispersion. You look at the returns of securities with one particular set of characteristics and their dispersion in returns versus returns of securities with absolutely the opposite set of characteristics. Like quality minus junk. If quality has done really well by historical standards over a 3-month, 6-month, 12-month period, then one needs to be careful whether some of that can be given up, or if it's the other way around, where junk has done really well, then it could possibly mean that you would want to be overweighting quality hypothetically at that point in time. So that's also one thing. Other things that people look at, things like institutional ownership. So that is sticky money. Institutions are typically steady hands. So if institutions start liking a particular factor, that could sort of bode well for that factor. It could have a long runway ahead of it. So those are things that people can track. Other things that people track could be things like short interest, short utilization. An event like the meme stock, the entire meme stock phenomenon comes to mind. January, February, March of 2021. Where you saw some of these stocks which had very poor fundamentals, to be fair, but the short utilization for those stocks had risen to 50, 60, 70, in cases 100%. That are levels where one needs to be very careful of, because that can tell you, a quick glance can tell you that you can run into very big problems, short covering, because if there's a scramble, where you're going to find stocks to cover. So short interest is again something that people can look at to assess things like crowdedness. Next up, what we have is something that is very topical, in terms of how factors recently have done, over the last 2-3 years, how factors have done, particularly in an environment where interest rates have been rising, something, we've not been accustomed to for the last 40 years. So, almost everybody on the call would have started off when in a regime where we've only seen interest rates go one way, right? So this is something that's very new for us. Most models would also not incorporate a scenario where this kind of thing would be even thought of. Again, but it is what it is, and what we've seen over the last 3 years. So this, by the way, is a chart of the quality factor and the value factor outperformance versus the benchmark. So over the last 3 years, what is the kind of outperformance that the value factor has seen, or the quality factor has seen? One thing that clearly stands out looking at this chart is that value certainly has made a stunning comeback. So on a 3-year basis, the CAGR for the value factor, or CAGR, alpha CAGR for the value factor was actually minus 25%. So it was absolutely bombed out in terms of performance. And the recent rally, or the 2 years of the last 2 years, the kind of rally that we've seen can be traced to the Pfizer vaccine day. That's when I said everything started rallying. That has now reached proportions which are very, very huge by historical standards. So if you were to go back to, let's say, 2009, from the March bottom that we saw in 2009 up until 2010, when value did very, very well, this current rally that we've seen in value has actually now surpassed that scale as well. Whether value will continue to do well or not, that is anybody's guess. But from an historical perspective, one can safely say that this kind of momentum will be certainly shocking if it were to continue for the next year or so. So that's one. Moving on, I think we've also done a lot of research on the low volatility or the quality factor per se. So for the viewers, I think it's very important for us to also state what the low vol or the quality factor is, because these kind of things can be used interchangeably, quality and low vol. So what low vol essentially stands for is companies that have a steadier business model. They have a dominant position in the market. Typically, markets often tend to extrapolate that current dominant position in the market out in the future as well. Sometimes it works. Sometimes there have been instances where company has been dominant for 20-30 years in a particular stream. Sometimes they sort of go away. But by and large, this is what the markets sort of extrapolate, which essentially means that a lot of the value that we see right now from that stock is actually coming from far out in the future cash flows. So what you do is you discount a lot of those cash flows in the future, which may or may not happen. Most cases do happen, but sometimes they don't. And a lot of value, current value, is actually derived from cash flows that lie far out in the future. That makes these kind of companies, or the valuation for these companies, very susceptible to small changes in discount rates. So whenever discount rate changes, you could expect these kind of companies to sort of when interest rates are rising, you would expect these companies to not do well, and when interest rates are falling, you would probably expect these kind of companies to do actually very well. So to test this, what we did was to look at the performance of a market neutral low beta index an index that goes long on low beta stuff and goes short on high beta stuff, and sort of looked at the performance of that particular index versus an index of long-term bonds, long duration bonds. What we saw was that, and these so this, by the way, is the TLT index in the US, where it has treasury bonds which have a residual maturity of at least 20 years, right? So there's no credit risk there. So the only way the prices of those bonds change is through interest rates. So what we've seen is that whenever interest rates are rising, of course, these long duration bonds would do poorly. And this has a very strong correlation with the alpha of the low wall factor, or the performance of this long short index that we're showing on the chart on the left. There's a very strong correlation. This year, what we've seen is that interest rates have gone up by 375 basis points. If you look at the federal funds rate, the 10-year, which was at 50 basis points in August of 2020, now went to about 4.3% in October of 2022. So a huge jump in terms of long-term interest rates. Consequently, this has meant that the TLT or the index of long duration bonds has had its worst drawdown ever since it was launched. And so the worst performance in 40 years. When you look at a relationship like this, it should not come as a surprise to anybody that low volatility or quality strategies have actually struggled this year. It should not come as a surprise. Reverse is the case for value, where a lot of the current value of these value companies, it does not sort of entail in the future. A lot of that is derived from current cash flows, right? So there we see an exactly opposite relationship. So the chart on the right is again TLT versus a market neutral value index, an index that goes long on relatively cheaper companies and goes short on companies that are more expensive. And there again, you see the relationship being exactly the opposite, which means a large part of the value outperformance that you've seen over the last 2 years can actually be zeroed in on the interest rate regime that we've been subject to. And so for low vol, this is value. This is the case. For quality, it is again similar. That's why I sort of clubbed quality and value together, because the performance is very, very similar in terms of, or the response function is very, very similar. Now, this means that a call on low vol is also by and large a vol on interest rates. So if you, as an investor, if you think that long-term rates have certainly some way to go, they've come off from where they were in October, from 430 to about 375, the 10-year. If you think that is still going to go up, if inflation still is going to be a problem that central banks will have to face, then it's probably not the right time for you to enter low vol yet. It's probably best to be again in a value kind of strategy. Whereas if you were to think that interest rates have probably peaked, the long-term interest rates have peaked, and you will probably find in growth concerns coming back in the market in 2023, and if you see future interest rates being actually lower, future long-term interest rates being lower than what they are right now, then this is absolutely a great time to be in low value. So low vol, for instance. So again, the decision whether to be in low vol or value or a combination of two, it depends on what your outlook for the large part is on interest rates. So that is where I will sort of leave you that with. And finally, again, it's very important to see where factor investing as a discipline is going. So there is a constant need to look at new factors. So a lot of research that has gone on so far has been around linear factors. Pharma French, for instance, than other momentum factors which were discovered. But most of them actually are based on linear models, which means, if you were to look at the momentum factor, for instance, what a linear model would say is that you would go long on the winners, which means go long on companies that have a high momentum exposure, and short the losers, companies that have a negative exposure to momentum, right? So that is what a linear model would say. What has happened recently is that a lot of work has gone on in looking at non-linear relationships between factor exposures and returns. So this is from the MSCI paper that they published, I think, a couple of years ago, which looks at these non-linear relationships between factor premia and exposure. So what this tells you, if you were to just talk about momentum, for instance, a very negative exposure to momentum is actually also not great for the factors. So meaning, so if you have been absolutely bombed out as a factor, you always run the risk of short covering or a dead cat bounce, right? Which means that if your momentum exposure is very, very poor or very negative, then it may not be prudent for a long short fund manager to actually short these securities, because you will always run into those sort of problems. So that's for momentum, but there are these non-linear relationships that exist in other factors as well. So a large part of the research that we've done recently has actually concentrated on unearthing these kind of non-linear relationships between between factor premia and factor exposures. Of course, this is done through relying on a lot of ML-based solutions. It requires you to sift through and analyze large amounts of data, which can only be done through machine learning algorithms. Good part is that a lot of data is now available. So when we started off 10 years ago, not enough data of this sort was available. Now more and more data is being captured, which can be put to good use to sort of look at these kind of relationships. Of course, it requires expertise to do that. But what is also happening is that how the landscape is changing is that the computational cost for doing this kind of work is also coming down. So earlier, you would require vast amounts of computing resources to be able to analyze this kind of data. Now there are other, Google Cloud, for instance, has a pay-per-use solution, so you don't have to pay hefty amounts to sort of have that ML engine. You can just use and fire up their engines for some time until you're sort of training your data set, and you don't have to pay for the rest of the month. So there are these advances that are happening in that field as well, which are bringing down materially the cost of computing these kind of linkages that we're trying to look at. So that's also happening. That's very interesting. Having said that, I mean, while machine learning does have its applications, there are some very unique challenges which plague the investment management industry itself, in terms of its usage of ML-based applications. The most important problem, of course, is the problem of ergodicity. So if you were to apply a ML-based solution in a closed set, like chess, for instance, it would work very well. Because there are only finite number of calculations that need to be done, and the rules of the game don't really change. When you're doing investment management, for instance, there are several unobservable factors that are in play, and a lot of these factors could be things like human emotions, for instance. It's very difficult to model human emotions. Unlike other fields where emotions, for instance, are not really involved, and there are a specific set of outcomes that are possible. The other thing is low signal to noise ratio, right? Because there are several factors that are influencing returns for stocks, and you could only observe a handful of them. That leaves several more factors which you've not really captured in your model, right? Which means whatever data that you're getting to analyze, that is fraught with a lot of garbage, a lot of noise. So you have to take out that signal, but that signal can be very feeble. So now there are techniques through which you could sort of improve the signal to noise ratio. You can use an ensemble approach where you create a multitude of these ML models and then sort of combine all of them together so that the noise gets cancelled out and you get a more purer signal, a more amplified signal. But again, we are in very early stages of having to do that. So that still remains a big challenge, low signal to noise ratio. The other thing that people also are worried about are things like overfitting. It's sort of, again, an overused cliche term in investing is that history doesn't repeat itself and it only rhymes. That's very true, actually. So whatever data that you've supplied, so what the model essentially is trying to do is to best fit a particular thing for the given set of data. Now, going forward, you could have the same set of circumstances, but investments or investment returns may not turn out the same way. So to give you an example, let's say, if you were to give the model, one of the input variables is, let's say, USD INR rate. If you take the example of 2013, when the INR was depreciating very steadily against the USD, you would have come to conclusion that probably IT is the best investment. Same thing happened in 2020, where the USD INR rate went up from whatever 75 to 80, 82. But IT really struggled as a sector. So there are these nuances that the model will never be able to sort of fully wrap its head around, and that's why you'll always find some kind of relationships between what has happened in the past, but it will never sort of entirely be true in the future. There will always be some of the other things that you would probably miss out. And finally, there's this problem of interpretability. Now, a lot of the investors that we speak to, and most of them, are fairly versed with the factor investing idea. We take a lot of effort in terms of explaining why we do certain things. Why do we overweight quality as a factor? Why do we overweight value or growth as a factor in our portfolios? And there is some economic intuition as to why we do it. There are very very clear reasons as to why we overweight something in the portfolio, underweight something in the portfolio. With pure ML based models, it sort of becomes difficult because the model will not be able to fully describe or explain as to why they are favoring a certain factor or a certain set of securities over others. So then again, interpretability, when that becomes a problem, it's sort of difficult to explain to investors as to why you are doing something. And that becomes a challenge to pure ML based solutions. So while there have been strides that have been made in this regard, it still is in its infancy, and it leaves a lot to be desired in terms of interpretability. So I'll finally leave you with this thought. There is this fully AI ML powered solution that is there in the market. This is an ETF called AI EQ, which went live in the year 2017. So there's no intervention from the fund manager side. It's just the model that is taking up positions, long and short both. And the performance of this particular factor or this particular ETF hasn't really lived up to its expectation. It was expected that this would do actually very well. And because it has learned so much over time, it would end up outperforming the broader market, which really hasn't happened so far. So there's still a long way to go before machines can entirely replace fund managers like you and me. They can at best be aids for us, but won't be able to replace at least for some time. So with that, I'll just pause here and hand it over to you, Rupal.
Thank you. All right. So we still have time for a quick fireside chat, and then we'll open up for Q&A. But for people who are listening, if you have any questions for Aparna or Pratik, please feel free to put them in the Pigeonhole link. My first question is more related to the first slide that you showed, which was more around this relationship of growth, inflation, and how that impacts different kind of styles, which to me stands out because if you look at from what played out this year, we were pretty much in that stagflationary kind of an environment where growth was going down, inflation was still stubbornly high, and you would have expected quality to do quite well, which hasn't actually happened. And it is not just in India. It's actually a trend that we are seeing even in broader Asian markets. So what do you think sort of went against this historical trends that we've seen?
Right. So it's important to understand that quality hasn't done well yet, and yet it's the operative word here. Right? So we haven't really seen the full cycle play out yet. What you've seen so far is only a duration sell-off, right? Not just in equity, but in credit as well. So if you look at the ETF that tracks the investment grade bond of the same maturity, and the ETF of high yield bonds that tracks the bonds of the same maturity, 5 to 10 years, the high yield ETF has actually outperformed the investment grade ETF, which I think is only because of the duration sell-off that we've seen. So if you look at earnings estimates, for instance, for calendar year 2023, analysts have penciled in a 5.5% increase in EPS between 2022 and 2023 for S&P, and for Nasdaq that number is 9.5%. So right now there is no earnings recession as such. At least that's not been built out in terms of estimate. If we do get that kind of, and this is very rare, again, like you said, for a market that is down 20-25%, for quality to underperform is very rare. But then going into this cycle, so much duration had been built into these kind of both equity and fixed income instruments. In fact, first this duration sell-off has happened, and we are yet to see a credit spread sort of blow out. So one, if you do get that earnings recession, for instance, where earnings are being downgraded really, so that's when you will see credit spread spike up. That's when you'll see high yield sort of the basket of high yield bonds actually underperform the investment grade bonds, and that's when I would think that quality would probably start outperforming as well.
Sure. So which actually brings me to the second question. So the fact that you think that probably the cycle is not played out and quality has not performed yet, but if you would have looked at, say, these historical trends and sort of used them to position, and which brings in this entire element of timing that you spoke about, is there actually, or even with a hindsight bias, was there actually a signal which could have indicated that we're probably not there yet, for quality to pick up, and potentially it could start picking up once the duration problem is solved? Because a lot of these things we can definitely say now, but throughout the year, at least the growth indicators were suggesting that we are in a slowdown. Inflation has been a challenge. From a pure quant perspective, one would have expected that at least some level of defensiveness to pick up, which has not really happened. So can we blend this historical macro regime shifts and add in this factor timing bit to sort of draw out any key signals that could help them navigate through, because the cycle could go on for a longer period of time, and hence improve the alpha?
So
Sorry,
go ahead. I think the first things first is I think it said this upfront also. It is incredibly fraught with risk or fraught with challenges to even attempt to time, and we had said this upfront because there are always some things which are similar and some things which are different. It's never the same. There are so many variables. So in fact, if you see the way we run our core quant driven funds, they are really the element of timing is not really a core part of the fund. So they are more based on, longer term, harvesting factor. We are not trying to essentially, we're not relying on our ability, to forecast these trends in order to generate any kind of excess return in a reliable way. However, that being said, there is one very interesting quote by Ben Graham. It says that, life is essentially understood backwards, but always lived forwards. Okay, but the point is, so, but again, there's no harm in trying to do these predictions. And so however, it is also, we do have these dashboards on crowding, etc. Like, Pratik said, where we look at which factor is crowded, extremely crowded, looking at valuation or price dispersions, etc. So maybe some of those signals could have, given us some kind of a warning that quality or low vol factor had become very crowded post-COVID, there's a massive sell-off. But there's nothing, so yes, we knew maybe it was crowded, but it is not possible to know that, when it is going to reverse beyond a point. For example, if the Fed had not stepped in, it is possible it would have gotten even more crowded, even more defensive, so these things are fraught with challenge. However, it is important to know now, if you look at the data now, the reverse seems to be, coming closer to the reverse happening, where it is now looking uncrowded. However, it is difficult at this point. It's difficult for us to predict that it is, it's going to reverse. All we can say, it is now uncrowded. So accordingly, as an investor, you use that as one of the inputs into your decision making.
Sure. So basically, you're saying that quality probably is uncrowded. What's at the extreme? Is there anything which is at the other extreme, and when it comes to India, in terms of factors, something which is extremely crowded right now?
So we don't see anything to be extremely crowded, frankly. We are seeing some signs of crowding in the value space or certain pockets of the value space. But I think we would probably not call it yet extreme.
Okay. Sure. And in this factor crowding, when Pratik was discussing this, of course there are again multiple signals based on which one can determine whether anything is crowded or not. But a lot of them are very different from the aspect of, some of them are fast moving, like say a momentum. Some of them could be a little slow moving, like say relative valuations, etc. So is there a way to, and in fact, how you have blended it when you look at crowding? Do you look at them independently? Do you bring them together? Put some weightages across, say, slow moving versus fast moving. Just give us a sense of how you look at crowding.
So see, honestly, we have looked at many indicators, and one conclusion that we have come to is that there is no one sort of holy grail. There is no one signal, and it's not a black and white thing. So you have to have an array of signals. It's like you're a doctor. There's no board flashing light. This is the patient, and the patient has got this illness. You have to look at a variety of, how is the patient looking. You have to do all these tests, and then they will kind of indicate you, okay, these are the possible problems. So it's the same thing. You have to look at multiple aspects, multiple signals, and just try and understand what is becoming more risky and where the risk reward is better, and accordingly orient yourself. I think that's the approach we prefer to take. And here also what we do, and even looking at fast moving or high frequency data, we study things like hit rate and win loss ratio. There is no 100% hit rate. Like, I have yet to come across something with 100% hit rate where if this data flashes this, then 100% of the times you can say with certainty that this is going to happen.
Sure.
You have to just try and play with probabilities and risk rewards, essentially.
Yeah. And sorry, I'll just probably have one more question before I move to the Q&A. This slide where you highlighted that there is this negative correlation between rates and low vol, and we showed the data for US. Have you done a very similar analysis for India? Do we see very similar trends even when replicated for India?
Yeah. So unfortunately, we don't have a sort of long short market neutral index in India. But what we did was we looked at the performance of the Nifty Quality 100 and the dispersion of that versus the Nifty value, and then regress that with the TLT, and it certainly showed a similar kind of character. It may not have the relationship is in terms of magnitude is not that great, but it's not a pure market neutral indicator. But broadly similar is what we saw.
Sure. Okay. All right. I'll probably move to the Q&A just to give the audiences a lot more time. Okay, so I can see quite a few questions here. The first one is, if value performs well in high interest rates, can its historical underperformance be attributed to low interest rates?
I think a large part of it could be, yeah. A large part of that is that, and of course, I mean, fundamentals are also one reason, but I mean, so the last 10 years, pre-COVID, I think a large part of that could be attributed to the fact that on a relative basis, something else was doing very well. And fundamentally, also they're not really performing. So it could be.
And just add to that, this is a very interesting question. We say interest rates and they were low, of course, but what is the reason they were low? That is important to understand. The reason why interest rates low is because generally we were in the whole world, or more of the developed markets, was in a kind of a slow growth environment. Demand was moving up very slowly, and when you talk about slow, environment, slow growth environment, then companies which where their operating leverage is very high, or where their linkage, where the profit linkage to the business cycle is it's a very strong linkage. So obviously, and these are the kind of companies which have value commodities, etc. So obviously, in an environment where we are struggling for growth, any companies which are sort of showing relatively better growth, steady returns, were getting rewarded. And and the fact that interest rates were low is a function of is on account of growth being low. So it's very easy to make these correlations, but to understand the context also in which. So yes, you can say it has a connection to interest rate, or understand why interest rates were low, and the fact that we were in an environment where growth is itself low. And obviously, companies which are highly leveraged to the economic cycle, which are more value companies, are then it's not difficult to understand why they they underperform their more growthy counterparts in that sort of a situation.
Sure. All right. The second question that I have here is, generally style trends in India tend to be quite similar to US. This recent decoupling of India, do you think that has legs? And if yes, how do you think one can play it heading into next year?
I think it needs to just be patient. So there will be periods where there will be this talk of decoupling, but eventually, if you give it time, they will converge, because wherever India does well relatively to any other market, there is this whole talk of decoupling. Is the same with factors as well, and eventually we find out that that's not really the case. So there will be short-term deviations which are par for course, but eventually I think they do, unless there's some country-specific problem. So as long as you're tied in with the global trade, global economy, you would find cycles typically play out roughly similar in most countries.
Correct. I agree. And the fact is that, whatever is the most recent thing, that tends to stick out in memory. But we actually went back 25 years and we studied, the data of different big economies and India. And there have been periods of time where, even long periods of time, when, some markets did better, some markets did worse. And that it has tended to reverse. So, we are ultimately connected to the global economy. There are so many linkages. There's liquidity, there's interest rates, there's currency, there's, the fact that we're an import. I mean, there are many linkages. So it is difficult to, and mean reversion is a very powerful thing, is what we have seen, at least as students of finance. So, we wouldn't tend to believe that tree can grow to the sky.
All right. The other question that we have here is low vol has worked quite well across markets this year, but not so much in India. Why do you think that has been the case?
Yeah, I mean, I think it's the same thing. You will have to wait for the entire cycle to play out. It's not, you can't sort of really point to a date and look at, point to point returns. You'll have to see the whole cycle play out. It has been the case that India has, or on a macro basis, also been relatively worse off. The kind of problems that you're seeing in more developed markets, for instance, US or UK. Those haven't really plagued India in that big a fashion. You have China, which is slowing down dramatically. Europe is undergoing an energy crisis. So a lot of the problems that you see elsewhere are also not really the ones that are plaguing India as much. And that could be one of the reasons as to why low vol hasn't really done well. But again, as I said, these things do tend to converge. And once you have a full-blown recession somewhere, in the US, for instance, which is widely sort of expected, then you might as well have factor performance converge.
Yeah. No, I think, and even to add to this, it is unfortunately this field of finance is such there's a ton of data, and the cause and effect, it is very difficult to say this is the cause and this exactly is the effect, and it will play out precisely like this over this period of time. So you have to understand that there are many variables playing their role in, and so you have to look for ultimately look for more longer term trends and not try to ascribe too much cause and effect to these very short term sort of moves. I mean, for all it could be more of noise rather than something very enduring or something very structural.
Sure. I'll probably take just one last question. Do you expect factor premiums to disappear if more investors embrace factor investing?
So, in fact, we touched upon this. See, the theory says, okay, if you read a lot of academic literature on factors, there are two reasons. One is it's not really, so it is a reward for taking more risk, which can't be diversified away. So it's not a free lunch or some excess return. It's coming because you're taking more risk. It's like as if you're investing in equities over longer periods, you are earning an equity risk premium. Like that, you earn a value premium or whatever size premium. So that doesn't get arbitrage, and even the behavioral bit doesn't get arbitrage, because we've seen those typical patterns of investor behavior repeat time and again, despite whatever level of sophistication, etc. And we saw that with a brilliant demonstration of that in the last 1 year. So basis this, it is you can say that, and also because anecdotal evidence is that investors are short term, therefore the premia exists. When investors start behaving very perfectly, maybe that time the factor premia will go away. So
fair point. All right. Thank you so much, Aparna and Pratik, for enlightening us with all this macro trends and how it impacts factors. Thank you so much for today, and have a lovely evening ahead. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.